the number one mistake is not having a plan. At least have a plan so it's measurable, and you have a place, a target that you're trying to achieve, a goal. If not, how do you know if you get there in 3 years if you're making progress towards that plan? All right, Robert, you ready for this?
I think so.
Okay, well, let's talk about today top mistakes that people make in wealth management in terms of, investing and whatnot.
Yeah, I think this is going to be interesting because for many people it's going to be, and I think you'll love it because it's part education, which I know you lack in, and intervention. But I want other people to know if this is a mistake they're making, they're not alone. It's very common, and that's why I love that we're going to talk about it today.
Let's do it.
Yeah.
You want to kick us off with questions that you've been thinking about on this?
Yeah, so I want to start at a different spot of why is estate planning a low priority when it comes to most people?
I think it should be a huge priority, honestly, but I think it's a low priority because it's something that people want to avoid. They don't want to talk about. Nobody wants to talk about death. When I die or my spouse passes away, how the estate should be set up. But the reality is that's huge, right? You work your whole life to accumulate some assets. You pass away. You don't have your estate in order, a will or a trust set up properly. A court is going to watch over that process of distributing your assets. Mm-hmm. So your assets may not go where you want them to go. You could have family drama, right? Why? If you have a business, maybe one child wants that business to stay in the lineage. They want to keep it. The other one wants to get rid of the business to have the cash today. From businesses to investments to think of this family heirlooms. It could be a piece of furniture in the house that somebody wants that had you put it in your estate planning to begin with, you could have avoided that. So there's a lot of reasons that you can make your loved one's life a whole lot easier when you decease if you have your estate plan in order.
Yeah, I know you and I over the years we've watched a lot of clients pass away, unfortunately, and there is a difference in watching someone grieve and allowing them to grieve properly because we had the tough conversations and we talked about estate planning to make sure that their estate was wrapped up properly and it's tightened up so that they could grieve properly. Nobody wants, when you lose a loved one, to be dealing with that anxiety and that confusion of the finances.
No, 100%. There's never a good time to have a loved one pass away, but there's also never a good time to really well, I guess there is a good time to think about that, what you want, and that's when you're sound mind and you're not, under this heavy burden of dealing with the death of a loved one. So you can process it when you're thinking rational, maybe with the input of that loved one. What do you think should happen to these assets? Who should get them? Should we put restrictions on them? So we can determine how much or how little they can get with the HEMS provision, health, education, maintenance, support. But the point is to have at least a dialogue while you're of sound mind with that loved one and determine what you want to happen to make sure it does happen. You don't have the court doing it. By the way, not only will the court determine who gets the assets and how, that's also a lot more expensive, right? Fortunately, in Texas, to be honest, probate is not as bad as a lot of states, but it's not ideal. You don't want your information out there public of what you left behind and who's getting what. I remember we had, I was going to say a few years ago, might be 6-7 years ago, we had a client pass away. The husband passed away. The information was public, and somebody came to this lovely lady's house, the survivor, and wanted to fix their driveway up their garage,
right? And
pitched them some crazy dollar amount. She went for it, and I think she just wasn't thinking sound of mind, right? It was like $150,000 to do a driveway, and so we kind of got wind of it, but it was after checks have been cleared and everything. Now, could she still have been scammed? Maybe, but had it not gone through probate, I think that person that scammed maybe not would have found out that this had been going on.
So going down kind of that same vein of just planning in general, is there a hidden cost in ignoring tax planning strategies?
Yeah, there's a lot of low-hanging fruit, right? It could be from short-term and long-term capital gains All the time, we're talking to people who they make a trade, which I may have recommended the same one of potentially liquidating a stock, but they did it, on the 340th day, and they could have waited another month and had a long-term capital gain instead of short-term capital gain. So that's a low-hanging fruit. Tax loss harvesting. I see all the time people creating wash sales. And wash sales, right? They'll own an investment. It goes down, and they want to buy more of it. They purchase more of it. And as it's recovering within 30 days, they sell the initial basis to get a tax write-off. Well, guess what? Now you don't get to have that tax write-off because you did it within 30 days. Yeah. This happens more often than not. People just they're not really paying attention, right? Roth conversions has been a big one we've spoken about. That's why I love software. A lot of times we're able to tell people, hey, if you do a Roth conversion, approximately this dollar amount, it's going to save you. Maybe it could even lower your estate tax, right? Because we're under that threshold, and now yourself or your beneficiaries are getting a lot more tax-free money. And sometimes we can convince people verbally, kind of give them an idea of what that might look like. But that's when I love having technology and showing them, whether it be ink on paper or on a screen, being like, look, if we do a Roth conversion, X amount over the next 6 years, this is how much we can save you. And it's a living, breathing thing. There's been times where with some clients, we'll do a portion of the account Roth conversion this year, and we intend to do it next year, but for whatever reason, maybe their income shoots up. We put on the brakes for a year. The following year, their income comes back down. We start the Roth conversion. So you want to have a plan, but the key is, I think, you want that plan to be flexible. Does that make sense?
No, you covered a lot, and I think many people don't know about wash sale rules or how a Roth conversion can affect them until they actually do the math or truly understand it. We could probably do a podcast on just simply that topic of tax strategies. But let's switch gears a little bit. When you first engage with a client or potential client at the very beginning of the relationship, what is the number one mistake that you find that they want to make or tend to make?
The biggest mistake is not having a plan, right? They don't know their goals. They don't know their risk tolerance. They don't know what they're trying to accomplish. You have to have a financial plan. If you fail to plan, you plan to fail. So you have to know what we're trying to achieve. And we see it all the time. Because that's going to be your North Star, your guiding light. If you know what you're trying to accomplish, then everything's going to fall in line. When we see a portfolio of somebody who doesn't have a plan, I'll say, well, why did you do this? Well, I don't know. I read it on CNBC or an influencer said it. Okay, well, why did you do this? There's no why behind it. And I think people get in trouble. They have good intentions, but there's not a reason for the actions that they've made. So the number one mistake is not having a plan. At least have a plan so it's measurable, and you have a place, a target that you're trying to achieve, a goal. If not, how do you know if you get there in 3 years if you're making progress towards that plan?
It seems like they tend to have some false sense of security or some overconfidence. So how do you avoid overconfidence?
So we see that a lot, and that's just in human nature. Some people call that winner's bias, right? Somebody, maybe they're a business owner and they have a massive success in a business, they liquidate it, and now they think they have the Midas touch, and they start another business, which, by the way, number one business that go under are restaurants, and that seems to be one of those businesses that people are attracted to. When they sell a business, have had some success, they want to do a restaurant because that sounds sexy. But on a side note, that's like the most risky businesses out there.
They might be a foodie like you.
Honestly, I would love to own a restaurant. Yeah. For a lot of reasons.
Just for you, probably.
To make the menu. Yeah. But going back to what we learned from clients, one of the things I learned is vicariously people's successes and failures. And, actually, that being said, we do have some clients that own super successful restaurants. Yeah. But that's more the exception than the rule. But I would say winner's bias is a real thing. You want to make sure that if you've had success in the past in something, that it is repeatable. I gave an example of a business, but it could be in a stock. Sometimes I'll see people with their portfolio, and they legitimately had some investments that were stellar, but honestly, I would attribute it 80, 90% to luck. For various reasons. That's a stock that there's no reason it should be up that much. I'll even ask them why they bought it. They can't tell me, they can't dive into the PE ratio or any research they did other than maybe it was a meme stock or something like
Or
that.
they shop there.
Yeah.
Yeah.
I mean, you have to make sure that when you're investing in something, you're not being biased,
Right.
or an influence pitch to where that it's legitimately based on research.
So what's the risk? We talked about people having biases, but what's the risk in somebody investing in just one particular stock?
One of the easiest ways to make a ton of money is to be concentrated. If I were playing a game and somebody said, "Here's $1 million. The game is in 3 years. I want you to grow it to 10." What I would do is I'd probably put it all in one or two stocks. That's going to be the way to do it.
Yeah.
But on the flip side, if you do that, that's a quick way to make the million go to 100K. But I think you're just adding a ton of risk. Yes, you have the upside potential if you're concentrated, but you have the downside. If you're young, maybe it makes sense if you're willing to gamble.
You were saying me. Right?
Young, not 55, Robert.
Okay, I thought you said you're young, so that's what I heard. Robert's young.
My bad. I mumble a lot.
It's all right.
If you were,
I appreciate the compliment.
hypothetically.
Yeah. So thank you.
55.
No, you don't have to worry about it.
Okay.
Thank you.
So if you're not 55, if you're perhaps 35,
38.
you might be able to be more concentrated if you want, but just be full aware that's a good way you could potentially make a lot of money, but you could get wiped out. As advisors, that's why we're never going to recommend that. We're always going to recommend to be diversified. That's a double-edged sword. So I'm not going to be able to convert somebody's $1 million into 10 million over 3 to 5 years. That's not going to happen. But if you're diversified and have around 1% ish in different stocks, the million also is not going to go to $100,000, right?
I think people get caught up in all the good stories they hear. Like you always hear about the winners in Vegas, you don't hear about the losers.
Yeah.
Well, you always hear about all the people that made money in this particular stock or that particular stock, but you don't hear about the thousands of losers. Yeah. And I know that you and I, over time, we've met people that have made a significant amount of wealth because they work for a company and put it all in. Sure. But then we've also seen that same stock go to zero, right? And then some that just stay in it, but they do have that bias. But that's the like you said earlier, that's not the norm. That's the one-offs that everybody else is trying to chase, and it just doesn't happen.
Well, the good stories are fun to talk about. I find sometimes if my son's asking about stocks, I find myself talking about my winners more too. That's more fun than talking about something that's down 30%. From time to time, we have stocks that are down significantly. But if it's a fraction of your portfolio, if you have 1% of your assets, even if it gets hit and it's down 20 or 30%, that's a fraction of your overall portfolio.
And depending on why it's down, it's also a buying opportunity to increase the holdings. So on the rebound, you lower your cost basis.
Could be. Assuming it rebounds. Yep.
So how much does behavior impact returns?
Yeah. So Dalbar. I think that's how you pronounce it. Dalbar did a study, and if you're not familiar with them, they're a research company in our industry, been around for a very long time. They did an analysis over 25 years of what the market did and what the average investor did that they did research on, right? During that time, the S&P was up 10-ish%, and the investors that they followed or did research, I'm not sure if they followed or did it after the fact, their average portfolio return was 4 to 5%. And after looking at that analysis, what Dalbar found wasn't that they didn't have access to the same investments. It had to do with emotional behavior, investor behavior, that they were trying to time the market, for example, right? And that's one common mistake we see. You can see people do it in an up market and in down market, meaning the market goes up and people think, man, surely it can't go up again. We just hit an all-time high. Mm-hmm. I'm going to put half my money in cash at this point, or very safe, and the market continues to rise. Well, now you missed out on that. And the more common thing is those 2 out of 10 years, which tend to be bad. 2 out of 10 years are typically negative. When that happens and somebody lost 10, 20, 30%, depending on how their portfolio is set up, then they, again, cash out a portion and they never recover. Yeah. So the emotional part, I think I don't know if it's the older I get or the more experience I get, but when I first started, I was really focused on the numbers, trying to tell clients, this is how we can make you more money by investing in this manner. And I've come to have a greater appreciation for the investor behavior behind it, the psychology behind it, of making sure that the investor can go along for the ride, right? That we're not making rash decisions and having those conversations with clients. Yeah, the market's up, but that doesn't necessarily mean we want to make it more conservative if you don't have a cash flow need. Now, every client's unique. Maybe if that client does have a cash flow need, yeah, that makes sense to scale the risk down or raise some cash. But if your retirement's off for another decade or two, just to make the account more conservative because it's rallied, I think that's foolish.
So to close this out, because I think it's been a great topic,
Sure.
what is one mistake that people keep making that you wish they would stop today?
Try to learn from others. And when I say from others, I'm not saying you necessarily have to find a financial advisor, but read books. There's a ton of YouTube content. I love to read. Reading's the way I've learned most of what I've learned in life, I feel like. But I would learn before making the mistakes. Try to avoid them. Like I like to tell my kids, fools never learn. Average people learn from their mistakes, and wise people learn from other people's mistakes. So if I'm an investor out there, try to learn before you make every mistake and fall in that pothole yourself. Does that make sense?
It does. I'm so glad you brought up kids, because the moment you said that, I kept thinking, well, most people that have kids, I have kids, and they never, you're telling them things to protect them, right? Because you've been through it, you've experienced it, like we have with clients. We've experienced 20 years of just market turmoil, market volatility,
and navigating good and bad times.
And we're trying to help them, just like you try to help your kids. But what do they not do? Listen. They don't listen.
Yeah, and I think with kids, I think it's part of it's human nature. I mean, when you're a kid, you have to make your own mistakes. But I think as you mature and get older, as you wisen up, hopefully you see kind of what's around a corner and you quit stepping in the same pothole. You know it's there. And the same thing with investing. Investing, there's massive repercussions. You're working probably 40 plus hours a week to save this pile of money, and then you're spending less time deciding how to invest and what to do than you're planning your next trip to Cancun.
Yeah.
That's crazy.
Okay, so thank you, Glenn. It's an enlightening topic. I hope the intervention for you worked well and the educational part worked well. I know it did a little bit for me being from Louisiana. But any final thoughts before we close out today?
If you don't have an estate plan, get it set up, right? There's thousands of really, really good attorneys out there that can help you. So get your estate plan in order. Make sure you don't have winner's bias. Make sure be honest with yourself. If you had some success investing, whether it's in stocks or something else, realize if that's repeatable or if it was luck. And lastly, try to learn before you invest in something. Learn about what you're doing, and try not to learn just by making mistakes. Learn by doing research, by potentially talking to advisors prior to making those decisions that potentially are irrecoverable.
All right, perfect, Glenn. Thank you. Now we're up to the mailbag question. So you ready?
Yeah.
Let's see.
You're the mailman there? You got one?
I'm the mailman today. This is from Josh. I don't know where Josh is from, but I'm sure he's a cool guy. I am new to investing. Where do I start?
Wow. The first thing is
that a tough one?
Well, it's simple but hard. I mean, it's first, what are the goals? What are you trying to accomplish? Make a plan for those goals. Look at how much risk you want to take. That's what would be the first thing. So let me start that over. I would say you would want to figure out what the goals are, the plan to achieve them, your risk tolerance. Depending on if they have debt, you want to pay down debt starting with the highest interest rate. Especially if you have any credit card debts, you need to get rid of that. Typically, mortgages and student loans are on the other extreme. They're typically very, very low. So go in order of interest rates. Higher the interest rate, paid off sooner. And lastly, you need to have money reserved for emergencies, right? Typically, what we say is if you're married or have a partner,
dual
and there's
income?
two incomes, exactly. If there's dual incomes, you need 3 months of money reserved. If there's one income, then you need 6 months in reserve. So those are kind of rule of thumbs. That's why I said it's kind of a hard question, because somebody may say, I'm a new investor, and I talk to them and they're not really new. They think they are, and then others are literally new. They're 18, 22, never bought a stock. It's a different conversation. But at the end of the day, figure out what your goals are, figure out how much risk you want to take, make sure you're paying off any debt, and go in order of priority of higher interest rates, and then have that emergency saved up. 3 months if you have 2 incomes, 6 months if you're on 1 income.
Perfect. All right, brother. Thank you. I appreciate the talk today.
My pleasure.
And I want to thank everybody else for tuning in. Don't forget to like and share. If you think this is valuable information, share it to a friend. And keep watching. Until next time, we'll see you here.
It's hard for me to focus. I don't know why.
Because my beauty. Mm-hmm. A lot of people have that problem.
You ready?
Do it. just so calm.
All right, you ready?
I'm ready.
Another episode, GDS Unplugged.
Wait, are we already filming?
I don't know, but I don't remember the topic. So, are we filming? Are we ready? Okay.